Welcome back to Alberta Primetime. Our province is swallowing a 30% discount on oil for world buyers. How does it affect all Albertans? And what or who is to blame? We'll ask the Monday Money panel that, as well as there are stocks earning 5-6%. How to pick them. Jane Elm is an investment advisor with Angus Watt Advisory and National Bank Financial. Jim Yee in tonight as well. He's a financial educator and founder of retirehappy.ca. Shafik Hirani is in this evening as well with us. He's director and senior executive financial advisor with Investors Group Calgary. Good evening, everybody.
Hi,
Good evening.
Hello.
Oil sands companies losing $18 billion a year against standard world oil prices in New York and London, analysts say. And government, eventually Alberta taxpayers may be indirectly absorbing some of that loss as well. Jane, not enough pipelines to ship it, not enough refineries to change it into different products. Two reasons among a few that we're getting less for our natural resource wealth. What's the problem here? Do we point a finger? Is it just the market?
Well, it's partly a combination of things. As you said, if you think of it as a funnel, where the production is the top of the funnel, the pipeline is the middle, the refiners are the bottom. The funnel can only take so much. We've now got production coming online in the U.S. from the Bakken area and down in Texas from Eagle Ford. So all that's feeding into the pipeline, which is taking capacity away from the Canadian producers. So without turning to trucking, which is much more dangerous than pipes,
rail,
or trains, again, much more dangerous than pipes and much more costly. There's not a way to get the oil out of Canada. And that's the ongoing problem, which is why we need to really address the Enbridge pipeline to the West Coast, and we really need the Keystone pipeline to be constructed. That will help. Because
CIBC World Markets, for one, just saying this could really turn into a bad scenario if it gets much worse. Jim, Canadian production, much of it from Alberta, forecast to rise to 4 million barrels a day in 4 years. How significant is the discount right now on Alberta oil and potentially for the next 2 years? How significant is that to Alberta's key industry, the oil sands?
On one hand, I mean, these are big numbers, so I think you can say it's significant. But I think if you look at it at a macro level, world demand for oil is only going to continue to increase, and any players on the supply game are still going to benefit. It's not like we're losing money. It's not like revenues are shrinking. I mean, that's really not what we're talking about here. I think that, to be in the oil game, we have to, keep up with technologies, and the pipelines are a big issue because, as Jane alluded to, part of the game is not just manufacturing the stuff, it's also distributing the stuff to the key players. And if, we have to remember too that Canada, 30 million users. In the United States, there's 10 times that, and then in Asia there's 10 times that.
Part of the problem, though, is right now U.S. demand is a little bit lower. Shafik, how significant is the 30% price discount to government revenue and therefore taxpayers, all Albertans?
Yeah, if you take a look at the government revenue right now, the Alberta budget itself is about $40 billion, and 25% of that comes from these the royalties on these natural resource plays. So the estimate for the Alberta government would be about 25% of that $40 billion, around $2.5 to $3 billion. There's a second way to calculate it. If the cost to all the corporations collectively in Alberta is $18 billion, it costs the tax on that $18 billion at around 20%. That works out to be about $3 billion bucks. So we're looking around a $3 billion cost directly, not to mention indirectly the people that are employed and the tax collected on that. So it's a significant cost, in my opinion, to the government.
Jane, gasoline right now, well over $1 a litre, even before summer demand hits. It accounted for 80% of February's rise in the U.S. Consumer Price Index. That's the biggest bump there in 10 years, mostly because of the cost at the pumps. Could gas be even higher if Alberta oil wasn't selling at a discount, or are we just not that big a factor yet?
I don't think it's that big a factor. I think the bigger factor is probably refining capacity, because we can't take raw oil, raw bitumen, and put it in our gas tanks. It has to be refined. So what we're getting is a manufactured product, a product that's gone through a lot of facilities. If we don't have those facilities to do more, then it's a supply-demand ratio, and prices will be higher based on that demand.
Next up, a key sign for future real estate prices, as well as high return stocks. How to find 6%. A good topic for the day. Apple makes its market debut. Alberta Primetime is back with that in a moment. Welcome back to Alberta Primetime and the Monday Money Panel. Shafik, before we get to finding high-yielding stocks, you're tweeting today about where Albertans' household debt is headed and how it could dampen real estate prices, despite Alberta Real Estate Associations today noting a cyclical spring uptick thanks to perhaps our generally nice weather, aside from the snowstorm in the eastern part of the province today. Tell us more, though, about the whole household debt vis-a-vis real estate.
Sure. First of all, I love that you're watching my tweets, Jen. Thank you very much for that. You know, when it comes to real estate, a lot of people, they look at just the basic supply and demand. If supply is short, then prices will go up. If demand is strong, then prices are going to go up. I think what a lot of people miss is they look at the average consumer debt to income ratio of the average Albertan. And Albertans are in the highest debt right now. We have the highest debt to income ratio of any province nationally. If we're in such debt, what's going to happen when interest rates go up? Basically, people cannot afford to buy more houses because they're going to be servicing that debt. So that's why I sort of tweeted that I think we got to look at more than just supply and demand. I think we got to look at how much debt Albertans are in when we gauge affordability of houses going forward.
Do interest rates rather look to be going up anytime soon, though?
Yeah, definitely. I mean, it's not a matter of how much, but the question is when. Rates are at an all-time low. People are looking at competitively locking in their mortgage. Rates are definitely going up. It's just it might be in about 6 months. It might be in 1 year, and that's where monetary policy comes into place.
Jim, do you believe that the real estate market in Alberta is truly looking positive? We got some good news out today from real estate associations. Number of sales definitely up on the year. But prices, Calgary condos, they're mentioning in particular, looking strong. How solid do you think the projections are?
You know what, I don't know how solid the projections are, and I'm not a big fan of forecasting. What I do know is that real estate is somewhat cyclical or seasonal, I'll say. You know, it's that time of year where, you know, there's more interest in real estate. The snow melts, people go out and look at houses. There's more suppliers and there's more buyers. So prices are purely a reflection of buyers and sellers. If there's more demand than supply, then prices will go up. If there's more supply than demand. So it's hard to know what exactly is how that's all going to balance out.
And in fact, you're not even a fan of buying on the cycle or selling?
No, I think that, you know, market timing in investing is difficult. Market timing in the housing sector is equally difficult. And I think that, you know, buyers of real estate, you're looking for a home, which is completely different than trying to pick the best time to buy. You know, most people, when you buy your home, you're going to live in it for a lifetime, and if you change, you're going to change for reasons that aren't so much about the price of your house.
We'll keep going around just with what people are watching this week. I know, Jane, you're looking to the federal budget. It's March 29th that we'll get that document. What in particular are you watching for on that front?
Well, we'll need to watch a couple things. First, we know that there's going to be cuts in the federal budget. Will it affect the civil servants? Will people be laid off or be furloughed? Don't know that. That'll come out in that budget. The second part of it is what happens on CPP and OAS on the age that you can access those funds. Will that be changed? If you take the age for CPP and OAS up to 67 and someone's planning on retiring and they're 64, that can change their retirement planning. So we need to be aware of that to make any changes.
Shafik, inflation numbers, something you're watching as well.
Yeah, you know, often when we're out looking and picking which investment to choose, you find that the Canadian market tends to mirror the U.S. market. So what we want to look at is what's going on in the U.S. for the stock markets. Inflation in Canada is important because that gives us a sign about what's going to happen with monetary policy. If inflation is above 2%, which the numbers come out on Friday, then you can see a movement in the Canadian dollar, and that'll affect our international holdings when we invest.
Jane, bond yield, something that people are watching too. A lot of people bought bonds when the market was low. They're a good, safe bet there. Things changing?
Well, things have changed because we have to go back a little further. When you look at what interest rates, and you just look at interest rates from the 1980s to today, they've gone down. 1980s, they were around 15%. Today, interest rates, the prime rate is around 2.25%. When interest rates go down, bond prices go higher. Interest rates can't go a whole lot further. They may not go up a ton, and as Shafik said, we don't know whether it's 6 months or a year when they start to go up. But we do know that any bond that we have, we can't expect to get capital gains. We can only expect to get the coupon, the interest rate that it pays. So if you're buying a bond that's paying 1.3%, then maybe that's all you can expect is that 1.3. You can't look for it to have the capital gain that you've experienced over the last number of years. So check your portfolios. If there's bond funds, talk to your advisor. Make sure it still fits for you at this point.
Okay. Jim, the big news on the markets today, especially Apple, you can now buy Apple stock. It's got $100 billion in cash, but is it a good buy?
Well, I don't know if it's necessarily a good buy or not, but it's certainly an interesting buy. I mean, it's certainly an interesting stock to look at because technology stocks are traditionally growth stocks, and you know, a lot of reinvestment back into new technology. But now here's Apple saying, look, we're going to pay out a dividend, and that kind of opens the market up to a whole new set of investors, which makes it interesting. $2.65 a quarter translates to about a 1.7% yield. It's not a huge dividend, but certainly interesting play. A lot of people will only buy stocks now if they pay a dividend. So now Apple's part of that game. So.
Shafik, there are some high return stocks out there. People always looking for them, but particularly now with things still being fairly volatile. REITs, or real estate investment income trusts, are among those earning 5-6%. How do we get decent dividends with the markets being the way they are? Is that the best bet, or are there others? How do we pick these stocks?
REITs the real estate investment trusts are yielding 5-6%. But you know, if you look at Canadian investments, there's a lot of large cap value investments that are yielding 5-6%. The banks are yielding, and the insurance companies, so the financials are. So are the telecommunications sector. So the one thing you want to do is when you create a portfolio, you want to create a portfolio that has negative correlations. That means when real estate goes up, other investments go down. When oil and gas companies go up, airlines go down. And if you have that negative correlation between the investments, then you get a more safe long-term growth. So what you want to do is you want to make sure you're diversified by yield and diversified by the volatility in these holdings.
Jane, are these typically holdings that you need to keep a close eye on? That, and what other comments would you have?
Well, first off, I would say not only that, but you have to bear in mind that the higher the yield, the more risk. So you can't assume that it's going to be risk-free. As well, that when you're looking at it, what's the sustainability of that dividend? If somebody's paying you a 6 or 7% dividend, can that company continue to pay it? And yes, you have to keep an eye on it. As anything else, when a stock gets to a certain point, you potentially want to take your profits off the table because they can go down just as easily as they can go up. Canadian banks have dropped 50% a couple of times. Yeah. So you want to make sure that you're always keeping an eye on your investments. They're not something you just put in and theoretically forget for the rest of your life.
Jim, is that something that you need to take on as an individual investor if you're going to pick these high yield, these higher dividend holdings? Or can you rely on a planner, an advisor, a broker to do that for you? Which is safe?
Well, I think most investors, to be honest with you, are not wired to do this. And so I think the majority of investors or people that I meet need help from an advisor to either do research or watch things. There certainly is a market where you can do this yourselves. The only thing I'll add to that is that REITs are quite trendy today, and I think you have to be careful about chasing performance. Last year, REITs were one of the best performing investments, and I think that's a large part of the reason why it's getting so much attention this year. And so when you talk about rebalancing and negative correlation, it might be a time to take profits off of that particular category and invest into, and bonds, another good example of an asset category that has done really, really well.
Shafik, what are the risks with REITs? Is it a stampede? Is that a factor? Is just the product itself? What are the risks there as we look at them today?
Yeah, the product itself has risks as well because they're usually less liquid than your typical mutual fund or individual security. They also have a concentration risk where they're in one sector. To add to that, you got to make sure where you hold this stuff. If you're holding it inside an RSP or a TFSA, there's no tax benefits. If you hold it outside an RSP, then you might want to look at more dividend yielding investments that have tax credits that are more favorably treated. And taxes, whether you get 6% on a REIT or not, if you're paying 40% taxes, try to target that 40% first.
Right. Thank you all for your insight tonight. Jane Alma is an investment advisor with Angus Watt Advisory and National Bank Financial. Jim Yee is a financial educator and founder of retirehappy.ca. Shafik Hirani in this evening as well. He's director and senior executive financial advisor with Investors Group Calgary.